auditor reports are not one size fits all. So there's unqualified, but then there's a couple different variations of what we can do if we're not going to say that it's unqualified, if we're not going to just give it a nice clean opinion, okay? Audit findings lead to matching the opinion to the correct audit report. So do the work, base all of our opinions on the facts, not come with like we believe the auditee, right? Everything's true, not come with such skepticism that everything is false and lies and misstated, right? We sit in the middle, we do our work, and we come up with an opinion that is based off of that work only. So unqualified versus qualified. A couple more terms for us, right? We love our terms. Which, by the way, I'm going to say, there's a glossary now uploaded into this class. So there is a glossary for you guys that's right in Brightspace, okay? All right, so unqualified is good. And then qualified, not so good. We've got some things going on. And then there's a couple other things that we need to talk about on that side of things. But simple terms, unqualified is good. Okay? All right, so unqualified, that's the best report an auditee can give. Where they say that it is not materially misstated and basically that the users can trust them. It means the auditor is giving a clean opinion and the auditee's financial statements present fairly in all material respects. Without changes or modifications needed to correct errors. So they're just good in the way that they are. They're not materially misstated. Users can rely on them because if there is something inside of them that's wrong, somebody made a little bit of an error, it's not material. It's not going to impact their decision, if there is one. The auditor has done the work to make sure that in all material respects, the financial statements are accurate. That the users can have reasonable assurance, not 100%, reasonable assurance, in relying on the financial statements. So this is an example of one, and this is 3 slides long, okay? This is, and the link is there when I give you guys the slides finally. It's SGI, and this is an unqualified audit report. And it comes with a whole bunch, and we're going to go through the sections, and I will bring them up, albeit it's small, so bear with me and go through the slides when I do get them there. But this is 3 pages of an audit report for SGI. So we're going to, and it's very scripted on what this is going to be. Now you'll notice, I talked about there's lots of notes, there's lots of things that we need to disclose as auditors when something is going on. So even though it's actually unqualified, there's still things that are being emphasized or discussed because the auditor felt that it needed to be noted. And that's professional judgment, right? All right, so 3 slides long, lots in there. So the standard unqualified, unmodified audit reports have the title, the address, introductory paragraph in the opinion section, an opinion paragraph in the opinion section, key audit matters, management and corporate governance responsibilities, description of the audit scope, signature, auditor address, and date. Now I didn't provide all of that in here because it was 3 pages long. But I do, you'll see, it starts with the introductory. Okay, so introductory paragraph in the opinion section. It's not better for me. So each financial statements are individually identified. So the statement of financial position, the statement of comprehensive income, the statement of changes in equity, and the statement of cash flows. The auditee and year-end are clearly identified, and these must be in this intro paragraph. There's lots in there, right? The opinion paragraph in the opinion section, the auditor is attesting to no material errors existing and the users may rely on the financial statements. The key words are presents fairly in all material respects. And it's in accordance with GAAP or IFRS, which you can see down here. So, in our opinion, statements present fairly in all material respects. And that's the way the audit report goes when it's clean, when it's unqualified. So the opinion paragraph is it. That's not right. I'm going to have to fix that. Key audit matters. That should say key audit matters. It's a new paragraph, and it increases the auditor's responsibilities. So I just took just a little snippet of it, but they're emphasizing the changes of accounting policies. A couple examples of this increased auditor responsibilities. Auditors must dig deeper into risks, going concern issues, critical accounting estimates, and disclosures on qualitative and quantitative issues. Does everybody know what a going concern is?
Yeah.
Yeah, okay. So there's more responsibilities that come. When the auditor is putting these key audit matters inside, they've done more work associated to it. Responsibilities of the parties, the paragraphs that are associated to that. So there's management, and then there's the auditor responsibility. So management is responsible for financial reporting, internal controls, selecting and applying accounting policies, making reasonable estimates, and ensuring the going concern. So that's what management's responsible for. The auditor is responsible for the scope, and then of course everything that falls out of that. So the audit work that's performed and all that professional judgment that comes inside of doing the audit work. And sorry, you saw, I took the 2 snippets out. This one was really long. Okay. So the auditor is responsible for testing the financial statements in accordance with CAS or DAS. Not doing the accounting. So if an auditor goes in and does the journals, and then again, can audit their own work, right?
Yeah.
So the auditor cannot do that. They're responsible for providing the reasonable assurance that there's no material error. So not 100% assurance. Reasonable assurance. They're responsible for assessing risk of errors by testing internal controls, obtaining sufficient appropriate evidence through CAS. And then for giving an opinion, good or bad. And that's that they're fairly presented. So when it's not unqualified, there's the qualified, the disclaimer, the adverse audit reports. So you have to select the correct audit report to match the results of the audit test. And then there's options when things don't go the way you want them to for a company, right? They need to be, we're going on the fairly and material side, but then we'll have to look at consistency and disclosure. And these are kind of ambiguous, so I'm going to talk about them more. So financial statements are fair, they're reliable, but we're not going to say they're 100% accurate. If I accidentally do a journal and I'm off by $2 in a reasonable size company, is that going to impact a user? In a small company, is that going to impact a user? $2? Probably not material, right? But there's going to be a $2 error somewhere along the line. Somebody's going to put some things in a bad decimal or something like that. So we're never going to say 100% accurate, because we're not going to be looking at $2 errors. And then we've talked about this. Why don't auditors attest to 100% accuracy of financial statements? Of course, the immaterial side, we only actually test a sample. We don't test every single one. And accounting estimates are used. So, I mean, allowance for doubtful accounts. That's mine. Who's to say whether that customer is going to pay or not? That management might feel they know, and this has come up in my career so much. I know that they're above their credit and they haven't paid, but I know them as a customer. So I'm not going to put them as a doubtful because I know that they pay well. We've got a good standing relationship. That one, like, you know, you get into the big numbers of how they decide to write off AR, and from an auditor's perspective, it's been outstanding for 120 days. What are the chances that won't get paid? There's statistics to that, right? As a general rule. But once you get in and you look at their estimation based on what they're giving as their reasons, and they have a track record that this customer actually always pays at 122, then you might not label it as an allowance. But inside of this, there's estimates, and that estimate might have been wrong at that time. You're going off of trending and statistics, not off of actually what is it paid that day. So because of these estimates. So these are the three major reasons why we don't attest to 100% accuracy. We can't actually say 100%. And then, so the material side, the financial statements are tested for errors that would affect the user's decision. So that $2 error, not going to affect the user's decision, right? But if I go to do the allowance for doubtful accounts, and I should be writing off or putting into the allowance $100,000 worth of AR, and I accidentally put 10, really changes the picture of what that collection looks like, right? So as long as the figures are not materially misstated, they are considered fair. Users and auditors understand that it is too costly to search for 100% accuracy. We discussed that, I think, the very first day, right? Management can't afford to pay, well, company can't afford to pay for what that audit would be. And the auditors, what kind of staffing would you need for that? So it needs to be in accordance with GAAP, which is the criteria for the auditing statements. Doesn't matter if the company is going broke, and users may be making a bad investment if the statements are presented accurately in accordance with GAAP. Doesn't matter. No. Are they presented fair? Are they fairly presented? If they're in accordance with GAAP, is it accurate? Picture may not be pretty, but if it's accurate, then the user at least can see that it's not a good investment, but if they make that investment, they're making it based off the truth, the fairly reassured truth. In my law foundation, I had talked about this previously, but basically it's the money that is held in trust. It generates interest. And so as lawyers hold money for houses and divorces and all these things, it sits in an account, and that account makes money. Well, whose money is that? It's the government's money, technically. That's the way the rules work. And so we come along and we go, okay, we're going to grant this out. Now, again, all sitting in legislation that we're doing this, but we grant this out. And one of the grantees that came to us for funding, they have to give their financial statements. And I got, like, you guys look at some pretty bad financial statements as examples, do you, in your accounting? Have you ever looked at nothing yet? Okay, well, it's coming. But you'll be given, like, a set of financial statements, and you'll have to figure out, like, what's wrong, what skews a person's decision, or is it a good investment, or what could be signs that the company is a going concern. This was exactly that, but they had a clean audit report at the front. So we as a board, we got to decide whether we thought that the grant money should go to them. Clean audit report, everything says that they're doing it accurately, fairly represented. But we decided to make our investment, or didn't make our investment, based off of that. So the auditor does not actually give an opinion on the investment decisions. Now, sidebar, not an auditor when I'm on this board, right? I'm on the other side. I'm the user making a decision. But the auditor does not give an opinion on investment decisions. Look at these crappy statements, don't do it, right? Auditor will not do that. The audit ensures the auditee has complied with GAAP in the presentation of the statements. That's it. That's all the opinion says. Whatever your use is, this is what I'm stating my opinion on. All right, so consistency, or the disclosure side. So there are things that are implied inside of this. Is that a term that everybody gets? Implied. You don't have to say it. You understand it. But there's things that an auditor does not have to say. It is understood to be true until they say otherwise. For anybody that, with that. So with the consistency side, the auditor speaks to a change in the application of accounting procedures or principles, but until a change, the audit report is silent. So the auditor doesn't say every year, this remains there. It's kind of inside of all the notes and everything when a person does a comparison, but it is assumed that it's consistent until the auditor says something, which we saw on that audit report. They were making note of changes, right? Right there in the audit report. Right there. But until the auditor says something, it is to be assumed that the financial statements, the procedures or principles that are used throughout are the same as they have been. The auditor doesn't say that, though, that this is the same. They use the exact same this, that. The auditor isn't saying that. It's only when there's a change. So the users can assume the client uses consistent application of GAAP, and then I use depreciation as my example. If they're always using straight line, that'll be. But the minute they change to declining balance, then the auditor will make a statement to that. They'll disclose that. And then on the disclosure side, if information is not obvious in the financial statements, but it is important to the user, it requires the auditor must ensure it is shown or disclosed. So it's kind of hand in hand with the consistency thing, but it doesn't always talk about consistency. So the auditor has to use their professional judgment. If the auditor believes disclosure is required and the auditee does not disclose, then a qualified opinion will be given. And so if the auditor believes that it should be disclosed, it's material, right? That's what they're going to say. Or it doesn't follow GAAP. But the auditor is going to go in and an audit, when you have those audit meetings at the end, as an auditor, you go in to the board or whatever the case, and they might argue some of your points. They might argue. And these will be the ones. So it's not black and white, yes or no. You're not just gonna take it and go, yeah, you're right? There's gonna be these ones where you apply this professional judgment and deem there to be more disclosure about something. Because as an auditor, you're saying the users need to know. And they're saying, I don't want to show. And then you have to talk about it. Because they're gonna argue, but at the end of the day, The auditor, if it's material or significant gap, any kind of gap change that will impact a user's decision, the level of disclosure is going to be there. Okay, so when it's not unqualified, then it could be qualified. Or it could be an adverse or a disclaimer opinion. So qualified, as much as it's the opposite of the not or of the unqualified, it actually isn't the worst that you can get. There's material misstatement, but not so pervasive that it impacts everything. There's something wrong in one of the accounts per se, but not the whole financial statement. Or there's a departure from GAAP. And then the scope limitation. But it's not like the departure from GAAP might be just one account. Not every single line of that financial statement. So we're going to qualify our opinion, but this isn't the worst it gets. So example of the GAAP departure, like some aspects of the auditee's financial statements do not follow GAAP, so just some. The auditor has reservations about some aspects of the financial statements, not complying with legislation, not using correct accounting methods such as depreciation or capitalization of overhead costs. You guys will remember when I talked about Mosaic. And when I first came in there was a lot of things running through repairs and maintenance. A lot. You had way less work to do when you put it through repairs and maintenance. But if it extends the life of an asset, there comes a point where we need to look at whether it's capital, right? And so they actually got written up. And that would be not using correct accounting methods. They were expensing way more than they should have been, and they should have been capitalizing. So that's an example right here in Saskatchewan of just as easily as that it can happen. And it's not because of management per se, it's because of the people on the floor that decided that it was easier to do it this way, right? $7 million later, just like that. It can add up real fast. $7 million, probably material, huh? A lot of changes after that. Scope limitation is the inability to collect sufficient appropriate evidence. So management prevents the auditor from conducting an audit procedure considered necessary. So reading the minutes, for example. Hi. Looks like I'm going to have to dial back my thoughts of swear words, huh? This can come up in other ways too. But you're good, like it'll come. But yeah, so this is a case where you don't have sufficient audit evidence. You haven't been able to finish what you're doing per se. And so therefore you qualify. You have a scope limitation. You define that scope at the beginning and you didn't get to complete a certain section of it. So the adverse opinion, this is the bad. This is the really bad opinion. This is where the auditor found significant misstatements, so the financial statements are not reliable. They can't even isolate out what part of the financial statements are wrong. They're just not reliable. It's the worst opinion that can be issued, and the company needs to restate and complete another audit of the financial statements. So it's a complete redo, right? You're going to be paying double your audit costs because they actually up the risk. So complete redo. And the worst opinion that you can get. So example, the auditor believes a company faces a going concern issue. It's not sitting in there in the evidence of the statements, and they need to say this is a problem. These statements don't actually present what it is. The company's financial statements present a large amount of cash, but the auditor discovers it's been misappropriated. There's fraud inside. It's pretty hard to just say it's just cash. And then you really start to question everything. Did you want me to be done by now? That's 30 minutes. No? Okay, disclaimer opinion. The auditor was unable to form an opinion due to insufficient evidence. It states that the auditor does not express an opinion. So this is where they can't. They just can't. They didn't get to do what they needed to do to even express an opinion whatsoever. So examples of that: an inability to complete all required audit procedures. There's going to be a level of significance in this versus the qualified. The inabilities to substantiate inventory balances, and that be this ginormous material concept that sits beside and then it flows through the income statement into the expense side to confirm everything, and there could be a bunch of fraud. It's just bleeding its way through the statements and its magnitude. Uncertainty about future cash forecasts. So this is disclaimer. I cannot give an opinion. I cannot.
Excuse me.
Yeah.
In the back slide.
Mm-hmm.
In the first statement, for example, inability to complete all required audit procedures. Isn't it the auditor's mistake that he was not able to do that? Or there wasn't sufficient financial statements ready at that time, due to which he wasn't able to?
If you're saying if it was the auditor's mistake?
Yeah.
Okay, so would an example be that they missed the inventory count?
They missed it. Why are they giving the disclaimer opinion to the company? The company is not at fault, na?
Right.
So why
but the auditor's at fault.
Yeah.
I mean, every single day the auditor better not be at fault. Every single day, right? And we get back to that whole legal liability. The auditor needs to do it right. Now, let's use, the answer to that is not going to be this or that, but I'm going to give you an example. So let's say the auditor misses the inventories count and it's their fault. If they got to get on it the next day, we'll say, or the 2 days, and then they got to do more work because now they have to work for the 2 days in between to figure it out. But I can tell you, if they get appointed after the inventory count, then it's going to be a disclaimer. We could not form the opinion. So if it's the auditor's fault, which I'm saying
No.
should not happen because you're already failed at part of your legal liability, they better do their work and way more to justify their opinion after that. There are cases where you can't always do the audit count right on the end of the year. And there are procedures in place to do that depending on the company. So there are things, but inside of your answer, first, don't let it happen, but second of all, it comes with more work if you can even get there. Independence, if an auditor is not independent, and they find that out once they're in, that's another example of a disclaimer. I can't form an opinion because I'm not independent. And that's once you're in kind of thing. So, you're going to probably end up on that disclaimer side. But depending on what it is, an auditor will have to, after testing, do more work. But yeah, first things first, don't do it.
Okay.
That's why you audit plan. That's why you do all of that, is to make sure that, and develop your scope, that you don't miss anything. Good question though.
And just a follow-up one. And if one auditor has given disclaimer opinion, the company can appoint another one and give the audit report again. Na?
After one has been given,
Like the company gets its account audited and that person gives a disclaimer opinion. Okay.
yeah,
And it doesn't justify anything. So the company can appoint a new auditor. Na?
yeah. So in the case of that independent, the auditor is not independent. They could go out and get another auditor.
Okay.
Yeah, and it's really up to the auditor to make sure that they are doing what they're doing at the right time. So they're actually giving a disclaimer opinion. If that's well into the audit, that disclaimer is going to be there. But depending on what the result of that is, if it's just pure independence, then that's one where you can get a different auditor. But there's going to be certain, because the users need to know, right? So if like the disclosure side is more gray, definitely more gray. But at the end of the day, you're disclosing that you couldn't form an opinion about these statements or something about them. Because disclosure too, like this is the disclaimer side, but I mean, there's so much that sits inside. You saw that unqualified report, right? All that disclosure is leading up to what could eventually be a disclaimer, depending on what it is, right? But if you can disclose, and still come up with an opinion, you're going to be there first. And on the qualified side, they can actually write up what part of that financial statement and that it wasn't so significant that they had to do an adverse or they had to completely pull themselves off. Good?
Yeah.
Okay. Almost met your 30 minutes. What's our end goal? So it's the audit report, right? So the auditor has an obligation to remain independent. We remember that one, right? If you can't do it, you disclaim yourself out. You follow gas and give an opinion on the fairness and reasonable assurance of the financial statements. So again, not 100%. You have the obligation to both the client and the user. You choose and prepare the audit report, and that's the final step in the audit process. So you've done all the work, you haven't defined your opinion in your audit report until you've done the work. You don't come in knowing what you're going to write. You provide the user with an opinion on the accuracy of the auditee's financial statements, and your choice of report is critical to match the auditor's findings and the auditor's opinion. So what sits inside a qualified audit report and an unqualified audit report is the auditor's opinion is going to say that they do, in their opinion, it's not material, it is materially misstated, right? On the flip side. Now, I knew I was going to get done early today. And with the quiz coming up on Thursday, what I would really like to see you guys do, I'm not going to follow you to the rooms. You guys have labs here or something like that?
Computer lab.
Computer labs? And
Yeah.
what is that?
It's just a room with computers in it.
Okay.
Yeah.
Okay, I would really like to see you guys go to that room right now and go over this stuff, L1, 2, and 3, so the last 3 weeks, and come at me with questions. And so for the next hour and a bit, that's what I'm going to ask you to go do, is go spend the time in the lab with your computer, or with a computer, or your computer, whatever it be, and spend some time in Brightspace and get ahead of this. I've done a lot of talking, and it gets great once you get inside of it too, I assume. Unless we want to go over terms. We added 2 today, right? 2 new ones, but just 2. What are they?
What?
Well, technically, I guess we can say we added 4. Qualified, unqualified.
Adverse and disclaimer.
Awesome. I can go over stuff. I can bring up old slides if you want, but I think if you go on your computer and work in Brightspace, I think that would be really good because then you're getting to apply it. You're going to come at me with something different than my voice.
A scope limitation and a disclaimer are very similar, except for, and this is just an assumption, the scope limitation qualification still releases the audit. Like, that's an opinion.
It's an opinion. It's a qualified opinion, but the auditor can still make an opinion.
Yeah.
They just indicate that there's a qualification inside of it.
Where's the threshold? So eventually enough things are going to go wrong that you're going to say, okay, there's been so many scope limitations that I can't give an opinion anymore. Where is that threshold?
And that's inside of the whole scope concept too, right? Professional judgment is going to be inside that. You're going to have tools inside of an audit that will help you get there, so to speak, and then obviously your audit team. But I'm not going to tell you that there's a set number or occurrence or magnitude or sensitivity, because these are all things, right? These are all things that are going to be considered. Is how sensitive is that? What's the magnitude, like the material side of it? There is no threshold except for professional judgment that sits inside of it, and now there's certain things that you just can't. If you're not independent, if there's a risk of that, you don't make an opinion, because what does that lead you to? Perception, right? The independence in fact or in perception. And if you make an opinion, it's going to be viewed as biased or not biased, or biased or not biased, like depending on the user. So that's when you just don't make an opinion. And that's going to be the threshold. So, which is none. But here, so let's go through some, let's take this, because I figured this would be something. So, is there a scope restriction? If the answer is yes, can the restriction lead to gas failure to prevent pervasive material, to detect pervasive materials misstatements? I'll say that one again. Can the restriction lead to gas failure to detect pervasive material misstatements? So, does the restriction actually disable the audit to detect a pervasive material misstatement?
Okay.
Yes, is a disclaimer. So the actual scope restriction makes it so that you may not identify what you need to do. And that's a disclaimer. All right, so is there a gap deficiency? If the answer is yes, does the gap deficiency lead to pervasive material misstatement? So again, the same question. If the answer is yes, that's an adverse opinion. Pervasive across the financials.
Sorry, can you say that again?
So first question is there gap deficiency? And does the gap deficiency lead to pervasive material misstatement? So this is the difference between qualified and adverse.
Yeah.
Qualified is not pervasive. Adverse is pervasive. So entire financial pervasiveness. So if the answer is no to that question, does the gap deficiency lead to material misstatement? And if the answer to that is yes, then it's a qualified. So that keyword, that pervasiveness, how impactful is the deficiency?
I'm assuming pervasive is well defined, because
You're right, it's a very, the term is ambiguous in a lot of respects. So with that, I'm going to just say, what you need to do is you need to take yourself out of the auditor role, and you need to put yourself in a user role. And if I'm this user, if I'm that, because there are going to be multiple different types of users, could I look at the financial statements and not care about that line? If it's just that line? Or does that bleed through everything so that my whole concept as a user, I can't trust any of it? And if the gap deficiency is there, then it's like I brought up the depreciation method. Well, if it's declining versus straight line, you're changing the amount that gets expensed every year, right? But at the end of the day, the same amount of cash went out for that asset. You're not changing the big picture of the financial statements, but you are changing the EBIT, the EBITDA.
Sorry, what?
Not a term you guys are familiar with?
Then before interest, tax, and
taxes.
Right. EBIT,
yeah.
yeah. Earnings
Okay.
before, yeah. Did everybody get that? EBIT?
Yeah.
EBITDA? Everybody? We're all good? Okay. So yeah, and I knew this would be a tough one, but yeah, the pervasive side is the key. And if it's more than one aspect of the financial statements, then you're gonna be going over to that side, but consider yourself a user and really go, how impactful is this, to see how pervasive it is. I'm not sure if it's in the glossary. I can provide more examples. I would like to write them up for you and put them in a way better than just words, if that helps.
Seems like something that would be a good discussion at the end of the course,
Okay?
when we're far more familiar with everything else.
Yes.
Then that becomes a really interesting question.
Do you get it better?
Yeah.
Yeah, agreed. That's great. And I've always said auditing is great. Professional judgment comes into play. And that does mean that it's not, the threshold is professional judgment, but where that sits inside of that can be different depending on the auditor too, right? Okay, I'll keep going through this one. So in the situation where there is a scope limit or a scope restriction, and we ask the question, can the restriction lead to gas failure to detect pervasive material misstatement? And you answer no to that. So again, no to the pervasive. Can the restriction lead to gas failure to detect material misstatement? Again, you're popping over to the qualified. So that pervasive is the definition for adverse. And then we just, got to figure out the exact hue that color that pervasive word sits at. And obviously, if the answer is no to any of these questions, then you quickly move over to the unqualified side. Anyone else? Is that, okay. Who's going to go to the lab?
Are you going to the lab?
Do you guys want me to go to the lab? I am here. I can go to the lab. I was told that you don't, but I can. I haven't seen Brightspace, so you guys got to give me a little bit of give.
I can do that.
You guys can go, you can do what you need, but quiz is coming. For those of you maybe that didn't hear that, quiz on Thursday after class. 5% of your mark, closes at midnight. You get